Well, Nvidia is ripping at the moment, up a lazy 54%, and that's underpinning the moves that we're seeing in the NASDAQ and the S&P. The Dow, however, lags as we see healthcare stocks getting carved up at the moment. Certainly United Health really seeing the sellers manifest in that situation. We are seeing some vulnerabilities in the US dollar. We are seeing some sort of signs that potentially we could be seeing a currency pact for some of the Asian countries, and we talk about that in today's episode of The Trade-Off. We are seeing some of the heat also coming out of the US, the gold price at the moment, and potentially we're seeing some further downside. We also look at crypto and Bitcoin in particular. There's a lot going on in these crazy markets. This is The Trade-Off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we will be discussing everything that's going on our radar and financial markets, what's going on in terms of technicals, in terms of the fundamentals, the price action, and where we see the balance of risk lying in some of the select markets that we look at. Mr. Blake Morrow, please come into the programme, my good sir. How are you?
I'm doing great, Chris. How are you? Happy Wednesday, Thursday? Happy Thursday.
Thursday for me, mate. Yeah, nearly the end of the week, but we don't want it to stop, do we? We just want it to continue. But a bit more of a calmer conditions. Some people would take that every day of the week. I want it to I think we can't have high volatility forever. We do need to see it come subdued for that next shock to come. But at the moment, things are looking pretty calm, and maybe we're going to stay that way for a period of time until we get the next shock. But I think it feels really calm at the moment, don't you think? Or is it the calm before the storm?
It is. It does feel like a little bit of a calm before the storm, which I'm happy with, but I'm ready for volatility to come back. I'm ready to rip, baby. Let's get some volatility going.
Yeah, I want it to come back as well, but I'm not against a period of calm. Obviously, it depends on how your strategy works in range expansion and volatility. I'd prefer the VIX above 30% personally, but some other people don't, and obviously you got to play your edge in those different market environments. So let's have a look at what's going on in those market environments, how we're seeing things shape up. Let's go to Topical Thunder. All right, let's go into the US equity markets. It's been front and centre this week. Obviously, Nvidia at the heart of that. Obviously, we've seen some good numbers from Microsoft, and we've seen, that stock's been supporting. We've seen Tesla supporting. It's really the Mag 7 plays which are at the heart of this. We have seen banks really failing to participate. Industrial stocks have done quite well, and that's been a winner. But, the breadth hasn't been brilliant on this rally recently. We've seen a really strong move up in Nvidia, and I think a lot of this is now people looking to chase. I know the equity market, certainly NASDAQ futures, CTA, systematic trend following momentum accounts, are now max long in NASDAQ. They've been flipping into increase long positions in S&P futures. Vol targeting, vol dynamic funds have been increasing leverage, and hedge funds too. So a lot of those flow-based effects have been there. And of course, you've got the options market, which has been such a prevalent factor. People have been buying out of the money calls in Nvidia. The stock price has gone up because the Saudis are buying 18,000 chips, and they've got a less onerous ruling coming through into fusion. As the price goes up, market makers are having to hedge gamma and bring their deltas back to zero. And again, that's perpetuated the stock up. So a lot of flow-based effects, a lot of sort of passive fund effects coming through, which have driven these high beta, high market cap stocks to really set the market up. But how are you seeing the balance of risk now in the NASDAQ, S&P? I want to talk about the Dow, but that's down to index composition. How are you seeing the balance of risk for those equity markets at the moment, Blake?
Well, as you pointed out, a lot of the tech companies are on the move. I mean, you have Netflix that's trading at all-time highs because they have the best content I've ever seen on any streaming service, hands down.
Yeah.
And then you have PLTR that was setting up a double top, but rallied to new all-time highs because nobody knows what PLTR does.
Do they care? It's trading at 180 times forward earnings or something. Just buy it. Fundamentals don't matter for that stock. I mean, for a lot of companies, to be fair, it's just you're just chasing the performance, just chasing it, baby, Momo.
Chasing it because no one knows what they do. But then you're right. There are pockets like in the Dow. We were just talking about UNH and how UNH is absolutely getting crushed and really weighing on the performance of the Dow. But right now, I mean, I think we're at a make it or break it level in the equity markets. When you talk about the S&P, broad market S&P, you're at the 78% retracement. So we are at risk of carving out a lower high. So from a trend point of view, that could be perceived as a potential trend change longer term. But then again, you look at stocks, which I am going to talk about, the DAX, for example. You look at other indices, you look at European stocks, DAX just hit all-time highs. But there's some risks out there. So I think we're at a very pivotal point. But obviously, the news from this weekend about the de-escalation of the trade war has obviously, helped equity markets. But I think the damage has been done. That's why I'm a little bit more hesitant about chasing the markets up here. Like I've been hoping for we'd see a pullback to 5,500 in the S&P to be a buyer. That seems like eons away nowadays. But that doesn't mean that we're not going to get a pullback. And I think I'd be more defensive at this stage in the game. Because you said it. Well, you said it correctly. You talked about breadth, and that's important.
So the thing with Nvidia is that you had for investors out there, they wanted to buy the stock, but yeah, they really had three overhangs that held them back. The first one was the hyperscaler businesses, your Googles, your Amazons, your Metas, all these players. We wanted to see their earnings and their commitment towards CapEx going forward. And we saw that. And Microsoft was the elephant in the room. And they came out with good numbers. And obviously the stocks had a good rally. They've committed to CapEx. And their reserve department has outperformed. So we sort of got that idea that commitment for CapEx is there. The second one was the diffusion ruling. And we saw that being rescinded and pulled. Effectively, these are the Biden era chip controls. They will get replaced, but the market's saying that we're not going to see anything that's more onerous on their earnings or any in terms of their export controls going forwards. Again, that's the second checkbox. The third one then is the big overhang, which market seems to be rallying at the moment. I think there's a lot of just momentum accounts and options flows which are pushing it up. And that it comes on the 28th of May. Look, I think the market's anticipating that quarter on quarter they're going to get revenue of about $38.3 billion. That'd be a 9% increase in revenue. There is a bit of a concern out there that they may miss that revenue number. So people don't want to buy the stock until we've got that through. And if we see them beat and raise as a result, the stock could fly. So there may be a situation for me. Nvidia is leading this market at the moment, and we've got to take a tactical view. Do we see people lightening up as we go into those earnings on the 28th of May? People saying, look, what if we do see a miss? And that may see a buying opportunity for me in Nvidia because, if they do beat the market, beat expectations, and they raise for the quarter ahead, you've got all three of those big factors for the longer term hedge fund funds out there out of the way. And I think that would really get them going again. So, everything that's going on in Saudi Arabia at the moment, very positive. We're seeing it more on the inference side as well. But I think that's a really, at the moment, you do have the pull breadth, which you focused on. But, as long as Nvidia is leading this market with the AI plays pushing up and you've got the rest of the Mag 7 supported, I think pullbacks will be fairly limited until we see Nvidia giving up in this market.
Well, I know this is a very U.S. centric show today, and it wasn't by design. It just kind of happened to be that way. But I'm excited to get to your third topic, which we're going to get to just after we talk a little bit about the dollar, Chris. And I do want to talk about the dollar because I think positioning was really at the heart of the bounce that we saw over the last couple of weeks.
No doubt.
We talked about the Economist. Magazine cover.
It literally nailed the load, didn't it?
Oh man, it worked out magically, and the whole market was so bearish. If you listen to, I'll tell you this: most YouTube interviews with macro analysts, those videos are not going to mature well. Especially over the last week and maybe over the last couple of weeks. But everybody was so bearish, and the dollar obviously had a nice bounce. But the thing about the dollar is, I think we had institutional, positioning very, very bearish, and I think positioning has squared up. And I've talked a lot about this over the last couple of days on some of our personal shows in our community. But I think the dollar is kind of squared up from here. But the pullback has been fairly minor, for a bounce. And therefore, I think the dollar is really, it comes back to the crux of everything, and a lot of people go, well, what are you talking about, Blake? Is it because the dollar is losing its reserve status? And the answer to that question, in my opinion, is no, that's not it. But there is going to be a continued, probably over the course of this year and maybe over the next couple of years, there's going to be a diversification away from the dollar as people want to remove some of this headline risk that we get. I mean, I can't tell you how many headlines we see on a daily basis, and you guys have seen them, that come from whether it's Besant, Hassett, Navarro, or Trump himself, that really can move the dollar at such an aggressive pace that I think reduction of dollar exposure is going to be the name of the game. And I think that's what's going to keep the dollar under pressure in the very near and maybe even quite possibly longer term. But how are you navigating this dollar volatility with the traders over at Pepperstone?
Well, I think that I thought there was probably a little bit more scope for the dollar index to rally up to 103, but the market just doesn't want to really push it up at any kind of great rate. I think one of the things we are exploring is this idea about a currency pact that Trump seems to, and the Trump team seems to have engineered with various Asian countries. I mean, we've seen that being categorically expressed from the Koreans. We saw a big move up down in dollar Korea yesterday, Korea won. We've seen obviously some big moves in the Taiwanese dollar. The Hong Kong forward rate seems to be pretty lively, and there's been huge defence coming through. You've seen that in the flows there in terms of 12-month liquidity. The Philippines, there's issues going on there as well. We've seen the PBOC fixing their currency at slightly stronger rates. It does feel like there's, on his tours and his phone calls, that something's been agreed upon for Asian countries to come out and sell dollars, and that's reverberating in keeping the US dollar from pushing higher against things like the euro and the pound and various factors. So I think that's something that people are exploring and looking to look at the moment. Certainly you've seen that in dollar yen, which has seen a few sellers playing through. Otherwise, I would have said, I think there was probably more ripe for euro dollar to push down to 110 before we saw another leg up into 115, 120 over a longer period of time. But I think this needs exploring. Whether Trump can actually engineer, if it isn't true that he's managed to engineer this currency pact for people to sell dollars to bring down their trade deficits, essentially. Does that go into G10? Does he manage to do something with Starmer's government? Does he manage to do something for other countries? I'm not so sure that happens, but certainly he's done it with, it looks like that's the case there with Asia.
Well, Chris, there was a person, classic, awesome journalism from Bloomberg today saying, not even a sources, a person denied that, but that is just a person. So we'll see.
The Korean, I think it was a finance minister saying that they actually did discuss a currency pact. So I think that's kind of where they looked at. But I want to switch gears and talk about.
Denied it.
I want to talk about the bond market here because, like when we talk about this idea about currency pacts or whatever it's talking about, is one thing is that Besant and Trump have talked about this disdain for high yields. Now you've got the 10-year trading at 454. Twos have moved up from around 360 to 405, and that's been a reflection, that you have seen rate cuts being priced out. We've seen, 1 year rates pricing about 50 or 60 basis points of implied cuts have come out. In terms of the expected rate cuts by December, we've seen about 51 basis points coming out there. So that's obviously lifted up the front end. But then the long end of the curve, you got the 30-year pushing against 5%, which was a big resistance, a big support zone for buyers, a couple of times back in April and before then. So we'll see if that you can get pushed higher before Trump and Besant start talking it down again. But what I think is really interesting here is we are talking again deficits again. There's going to be less tax receipts from tariffs. That's going to be lower. Doge aren't really creating the efficiency drive at the moment, and they're trying to pass a bill. They just passed a bill, the reconciliation bill, with the SALT deductions, which they're trying to push that up to 40,000. They're trying to, obviously the tax cuts, they're rolling them, extending them over, but potentially looking to increase the deficit by $4 trillion over the next decade. And they're not offsetting that by the level of tariffs again, so that could increase deficits. and you've got that long end coming, and it's driven by term premium. So that's the compensation that investors need for effectively taking that long duration risk and not being, just rolling over the 2 year, for example. That's gone up to 69 basis points. If that was to push up to where we were in April, 1%, I think that you're going to see higher long end yields, and I think the equity market wouldn't like that situation. So we are watching this debt bill trying to be passed through the House. It'll make its way to the Senate maybe by before recess, 2nd of July. How are you seeing the bond market? I know I've just eaten up a lot of time, but how are you seeing long end yields, and do you think they could be something that could derail the equity market and maybe lift the dollar here?
Well, for most of your listeners, I'm going to dumb this down for you, for you and myself included, from what Chris just said. Basically, the bond market's saying, hey, how are you going to pay for everything that you want to do? You're going to have to pay me more for this, and that's why bonds are going down, yields are going up, and what's going to be really interesting, Chris, is going to be when you see this breakdown in the 10-year, like the notes, for example. I mean, as you pointed out, yields are ripping. Dollar is not responding. I mean, the dollar responded a little bit today, but I think that's going to be the bigger issue. Is and you and I talked just before we started recording, and you're like, yeah, seeing who is subscribed to these auctions is going to be really key. That's something that you pointed out to me, but also it's going to be how the dollar's response to this is. And, you remember a couple of weeks ago, people were fearing, like, when you saw yields go up, but bonds are going down, the dollar's going down, equities are going down. Don't be surprised if we don't witness that again in the coming week or weeks. Mm. And I think that's going to be the big issue that we're going to be faced with, going, oh my God, everybody's selling anything America again.
Yeah, I think it's interesting because, you've got the X date, I think, for the debt ceiling comes out in September. But if they pass this reconciliation bill through both the House and the Senate, and there is some big conjecture about things like the SALT deduction. So I think in America at the moment, the average American can come out and deduct $10,000 in their federal tax deductions. They're talking about trying to push that up to $40,000 for certain, or $30,000. And I think certain richer states are trying. The House Republicans are trying to push for even higher. Again, that's less tax the government's going to have. And I think for me, Blake, I don't think people are generally concerned about the deficit at the moment in the US, because it basically steals growth from the future and gives growth to the US right now. But, as yields go up, you are talking about higher interest payments, and it's just something that just gets pushed out for future generations. The US are not going to default on their debt. Let's not be clear on that, though. That's just not going to happen. But at some stage, someone has to do something about it. You just can't keep going up and up and up and up and up at the sort of levels that they have. I know no government wants to go and fix the problem, because you'll lose the next election. You'll probably cause a recession or do something so severe that will cause huge ramifications. They just keep pushing it up and they keep increasing the debt loads. So effectively someone will have to do something about it longer term. But right now, no one wants. But you just lose an election, don't you?
Yeah, you do. And you know what? It's so depressing. I'm going to walk my kids out into the pasture and put them down.
But they're old enough.
I don't know. They kick my ass. They're like, Dad, where are we going? Then they kick my ass. Anyway, no, I mean, let's get off of such a depressing topic. Let's talk about our fourth topic, which is the data that's tomorrow that could drive the markets. CPI had been a driver this week, but tomorrow I think is going to be another, just data dump. We've got obviously the weekly unemployment claims. We've got producer prices. Market's going to be focused a lot on PPI tomorrow, especially, some of these inputs that producers have that they're going to be passing on to the consumers, and knowing what's should be coming our way in the coming months. You got, we have, I think we have GDP. No, we have retail sales. So how's the consumer holding up in all of this? And then you have Philly Fed, Empire State Manufacturing, two manufacturing data sets that could really set the pace for tomorrow. And I think today was a nice consolidative move. And I say today, your Wednesday night. It was Wednesday day here in the U.S. It was a very consolidative day in the equity markets. But I think markets are really poised to break one direction or the other tomorrow. How are you looking at the data that we've been receiving this week, and going from the CPI data that we got earlier this week to producer prices that we're going to get tomorrow, Chris?
I think markets are going to give it a very big cushion, to be honest, Blake. There have been a situation where we were going, well, the data we're getting is stale. We want to wait for the impact of the higher tariffs to kick in. We've already seen that in the soft data. Now we need to see it in the hard data. And now that data is going to come in and it might be weaker. But then we're going to say, well, what happens to the next data series? Now we've got the lower tariff rates. So I think people are just giving this one a wide berth and they're playing the holding game. We know the Federal Reserve are. So I want to see, I think we were all sort of giving a very low amount of credence to the soft data releases because we knew they were weak. But now we've got this new tariff rate on China and we've basically got the effective tariff rate more broadly down towards 13%, which is still a big number where we were, but obviously it's come down a lot. Will the soft data surveys now rebound in the next ones that reflect the new set of tariffs? If they do, then we may get a situation where the hard data doesn't actually crack at all. We just don't know. And so therefore, I think, what we're going to see is just the market giving this one a bit of a wide berth and a really big cushion against a miss because things are just changing so much that, once we get, I think what we want to do is we want to get to a period where those tariffs are held for a long period of time and then see how the data is affecting. And then, of course, we want to ask ourselves, what's the chance of them changing once we get to the end of the 90-day deadline, and then obviously the China 90-day deadline, will they be pushed up? And I think most people expect them to be rolled over. Certainly the US-China deadline will be rolled over because they're not going to formulate an agreement as such. It takes years to do that. And their starting points are too far away. So they'll probably get rolled over. But there is some concern that the higher the equity market goes, lower volatility goes, the more chance that Trump may have to go harder back again he might give him more scope to review those tariff rates and push them up. So do we trust them? I don't know. And that could cause some volatility.
It will. And you talk about soft data. The thing is from my point of view, from a boots on the ground point of view, not a lot's changed. I still talk to a lot of business leaders, even in my local environment. People are still very, very iffy about the future. They see the volatility. They're especially the business leaders. They see what's happening. They understand the unnerving nature that we're in right now, and they are yet to commit to certain projects and capital. And
I think that's the most important thing, right? So now you've got the US-China agreement in place. You're in the Exco team. You're in the senior leadership. You get into the boardroom. You say, right, we didn't have the visibility before to make those CapEx decisions, to make those investment decisions for 12, 24 months ahead. Do we have that now? I'm not so sure we do because the goalposts may change. They may commit a certain amount of budget towards investments and growth, but I don't think they've got any really strong conviction behind the visibility. What I think it does do, though, Blake, is I think it mitigates mass layoffs or increased layoffs because people didn't want to get rid of staff before. I think, you're probably going to see that. What I'm watching very closely now, and we've got to change over, are the continued claims. There's been a very strong correlation over the years between the rate of change in continued claims and the unemployment rate. So that obviously comes out a week. So I'm watching. I think continued claims that you see on a weekly basis, part of the jobless claims. I think that would be something that the market's going to look at very closely. To give you a sort of a high frequency understanding of how this all goes. Anyway, let's go to that's a setup. Let's go to the HK50. We kept it stateside in the last segment. We're going to go a bit of a global tour now because not everything evolves around the US. Most of it does, but there are obviously some flow-on effects. And what we're seeing now is a much stronger tape coming through in Hong Kong. Now we've just seen some good earnings coming from Tencent. We're going to see how that stocks reflects today. But what we're seeing in this chart here actually reflects the futures move. So that does include the 10-cent move there as well. But this is ripping, and you can see I put an 8-day exponential moving average. I just like to see that because it sort of defines the trend. And when markets are making that impulsive move up, that strong move up, you see pullbacks being contained into that, and it really has done that really from mid-April. So I feel like this one continues to go higher. If you have a look at the CN50 or the Chinese mainland equity markets, they also look pretty good and they're looking to break out. But the momentum at the moment is in Hong Kong. I've seen a lot of people talking about being long Hong Kong stocks and long Hong equity at the moment. I think this one trades up yeah, I think this goes up and tests the all-time highs. Again, I'm wrong, and I'd look to reassess this on a daily close below that exponential moving average, the 8-day. Just something real simple like that, just to show you, because it's been working. And I think as long as it's defined there, it's onwards and upwards. I think we get new highs in this market, Blake.
Woo, man, that is a trend. I love that 8-day moving average, Chris. That's a good one. I know you use it a lot.
It takes the emotion out of trading. Just follow the flow.
Yeah. Oh, yeah, I need to get that strapped to my forehead then. All right, my first setup is going to be the US dollar Norwegian krona. And this is really interesting, Chris. We've seen the euro come down from 115 to trading down to, sub 112 as at the time of recording. If you look at the US dollar Norwegian krona, which is the one on the bottom, which is the actual candlestick graph, not the line chart. The line chart is the upper one. That's the euro. The US dollar Norwegian krona has gone nowhere. It's actually trading not too far off trend lows. And this is one of those currencies I don't have any exposure in, but once I get the all clear, just what I'm looking at is all clear, just so everybody knows, is the euro gets back above the 112.70 level, because that's the breakdown point of the euro. So if the euro gets back above 112.70, we rejected it today, actually in US trade. So we get above that. That means the dollar is actually moving down. The US dollar Norwegian krona, hot on my radar as a setup for potential short into new trend lows. It has been outperforming the euro, and I want to play into it. So there you go.
Good stuff. Let's go to gold. Can't go past gold because it's the heat's coming out of the gold price. Obviously, a lot of people talking about this at the moment. We've got a double top in play. The neckline takes us down to 30.50, perhaps a little bit lower than that at the moment. Obviously, there's a big position unwind. People talking about the US-China tariffs. Do we need to hold gold as a hedge against that? We are watching the flows coming through China. Obviously, there's been a large amount of increase from both retail and institutional involvement into the ETFs and into physical gold. Now, we'll be watching those flows, because what we've been seeing last couple of months is, as soon as the performance comes in Asia opens, you see the gold price, certainly on the COMEX as well, pushing high. We'll see if that unwinds. But the world has been very long in gold in all different forms, and we're just going to see how much of those flows happen, because once everyone stands on one side of the ship, invariably that ship sinks or tips, and I think that's what we're seeing at the moment. The technicals at the moment, obviously, we've come down to the former breakout highs coming through in March, in early April. It needs to bounce here, obviously, otherwise that target that I've got for 3,050, 3,000 comes into play. So we are at that green line. Can we break through there? Obviously, right now, the balance of risk tilts towards being short. I know that makes me a bad person, because the call to gold says you have to be long. I've been bullish when I need to be bullish. I just trade the trends right now. I feel like the probability is that this can go a little bit lower. I'm a bit concerned about what happens in the bond market. I think, gold hasn't been really reflecting yields for a long time, but I think if term premium does kick up, I think that could be negative for the gold market and take us down to the 3,000 level. But at the moment, on that setup, just purely looking at the setup, forgetting everything that's going on in the fundamentals, I say the risks are lower here, Blake.
All right. Well, Chris, I love how you trade the trend, and something you've been all over is that gold bullish trend. Yep. And it's nice to see that you go both ways. And I'm saying that in the most friendly, don't touch me kind of way, Chris. So
it's a family show, Blake.
All right. So, hey, my last setup is going to be the German DAX. Speaking of a trend that you've been on, Chris, you've been talking about the outperformance of European equities over US, and you've had that spot on. But things changed this weekend. I think we have a gap of time. I think we have a gap of time, whether it's full 90 days or maybe it's just a few weeks, where you start to see a little bit of underperformance in European equities like the German DAX, and you see outperformance of US equities. Therefore, if you look at the DAX from a technical point of view, we're actually creating a false breakout. So a false breakout, in my view, always leads to, or not always, but almost always, if you will, to a breakdown. So that means there's a good chance that we could drop below the 50 DMA, which is that orange moving average, back down to the 38% retracement, which is around 22,000 in the German DAX. Now, if we get further downside in the DAX, it's probably because we're seeing a global sell-off, not so much an outperformance of the US. But I think the German outperformance, at least in the very near term, is over. And I'm looking at this chart as a false breakout. If you want to be on the short side, I think that is the setup, as long as you know your stops have to be above the highs, because you don't want to be short if it's still hitting new all-time highs. But false breakout might give you a nice setup for a short.
Yeah, I think we are getting into a world now where, long short strategies make a lot more sense. We'll see what the technicals, just those delta ones or one directional kind of trades, I think they're going to be interesting as well. But you've just got this constant climb. I still think China and Hong Kong looks quite good. Japan's been very strong recently. The Nikkei's been very strong. We're seeing a bit of heat coming out of there. You just got to stay on your toes, haven't you? You've just got to let the price come to you and tell you what you need to do and look at the probabilities around that. Don't fall in love with a position because this market will school you if you do. Anyway, let's go to play of the day. Play du jour. I'm going to go Bitcoin. I've been pretty bullish on Bitcoin because the price has told me to be so. But we're now seeing another consolidation. This is consolidating, breakout, consolidating, breakout, consolidating. So again, this is one for the radar. I am very much open-minded to where this goes. I am not put off by the fact that it's got 100 as the big number in front of me. That doesn't scare me at all because I'm absolutely loaded. But I'm joking. No, but it doesn't put me off. I think the market's spent enough time above the 100,000 level to lose that taboo about this being more expensive because of the psychological issue. I don't think that's the case at all. We're actually watching the ETF flows, but if this can properly kick through the 105 level, then I'm bullish. Where I think this is probably going to go now, I think we're actually going to see it trade lower. That's where I see the balance of risk now. I haven't got a position, but price is still above that short-term moving average, this short-term EMA moving average, and that keeps me out of those short positions for the moment. If we can see a close below that 8 day, then that would change the balance of risk. It tells me that the market, this strong rally that we've gone is probably over. And I think that those orange closing lows that we've got at the top line there, if we can get a breakthrough there, I'm short for a move back down to 97,000 for that level there. So I don't have a trade at the moment because the market's consolidating. It could go either way. There's not a high probability setup at the moment. As I say, it kick either way, and I want to reactive to that. But the set for me is if it can break that 8 day exponential moving average, even more on a closing basis, through that orange horizontal line, 97, and then I think we'll get a quick move down to 97,000. I think there's a good trading opportunity there. So just let the market come to me, and I'm happy to trade Bitcoin on the long side, happy to trade Bitcoin from the short side. It's just the price in the end of the day for me.
Well, Chris, if you take that entire chart that you have right there, we call that a shark pattern. So what I'm going to call you is, Chris, you are
Baby Shark.
Daddy Shark.
Daddy
Shark.
Shark.
Daddy Shark. Well, if you haven't kids under the age of 10, anybody knows the Baby Shark song. But that is a shark harmonic pattern. You guys open up your textbooks, take a look at it, and that would suggest there is going to be a little bit of error coming out of the Bitcoin chart.
Well,
Daddy Shark.
We've moved on from Baby Shark now. We're on Let It Go by in Frozen. So that song
Frozen.
So that song's on repeat at the moment for my 3-year-old. So
the joys of being a parent. All right. Man, I'm going to give you all sorts of love today, Chris. My play of the day is actually the pound Kiwi. And this is a chart you brought to our attention 2 weeks ago. I want to say a week or two ago. You talked about this ascending channel. It was a great place to be on the long side. I remember it was around 223, and we've rallied from there. But now I'm going to expand on your idea and suggest that it still is a topside breaking potential trade, something I'm actually looking to trade because I didn't participate when it was on the channel support. I didn't listen to Chris Weston on the trade-off show a couple weeks ago, as I should have, but I know some of you did. But if we break that 38% retracement that comes in at 226, 227, you start breaking above that, that is going to be a clear-cut breakout in an ascending channel. That's my play of the day because that's something that I'm actually looking to get long. I don't have a position, but this is also going to complement if equities are carving out a lower high, which they might be, then the pound Kiwi is a perfect type of trading instrument in a risk-off environment when it tends to go up when equity markets go down. So this is one that's on my radar as play of the day. I'm not in it, but I'm looking to be in it, Chris.
Very good, very good, very good. All right, thank you, Blake. Thanks for all the thoughts and kind words as well. And thank you, everyone, for home for watching the show. We do really appreciate it. Click the like button if you can, and leave your comments where you can as well, and we'll look at those with great interest. See you back next week for more.